Hello and welcome back to the Military Money Manual podcast. Spencer Reese here from militarymoneymanual.com. Today in the podcast, I want to talk about asset allocations. I want to talk about investment portfolios. I want to talk about 10 reasonable asset allocations, 10 reasonable portfolios that I recommend for military service members. During an investor's early years, as you move from a financial novice and you start to build knowledge and maybe you upgrade to a financial acolyte, usually you've learned the importance of keeping costs low, buying and holding investments, not trading, day trading, choosing passive investments over active ones, because as we know from the data, passive investing outperforms active investing over long periods of time. And you might learn about the efficient frontier, and you might learn about other asset allocation theories. And there's usually a period of time where the young investor or the new investor becomes obsessed with choosing the perfect portfolio. But the thing is, the truth is that no one knows which portfolio is going to outperform in the future. There's been several studies done. One of the great ones is on the Bogleheads forum, and the user looked back at diversified portfolios over the last 20 years, and no portfolio did better than 1% to 2% per year compared to a similarly risky portfolio over that time span. Now, 1% to 2% a year does matter, especially over long periods of time, but keep in mind that the edge is on a very complex portfolio, and it might get degraded over a very simple one because it can be eaten up by advisory fees or behavioral errors or poor tax management. And it's much better to focus on just choosing a reasonable and rational portfolio and recognizing that there is no perfect portfolio. So pick something reasonable, stick to it for decades. Don't chase fads like value investing, small cap value tilt, cryptocurrencies, long-term bonds. You just need to pick a low-cost, automated, diversified, and simple portfolio that you can stick to and that you can ride the good times and the bad times, and you don't suffer from too much fear of missing out or FOMO. So here are 10 portfolios that I think are reasonable for the average military or even the above average military investor. Number one, a Lifecycle fund. This is the low-cost, automated, diversified, simple investing, the LADS method at its prime. You can select a Lifecycle fund for your thrift savings plan, your TSP account, and it's a one-time decision. It's a set it and forget it. For instance, you might be, let's say you were born in 2000, maybe the L2065 or the L2070 fund. The Lifecycle funds are automated. They're selected by investment professionals inside the TSP. They're at extremely low cost, usually under 10 basis points, or if you have $100 in there, you're paying less than 10 cents a year to be invested in them. They're automated, so they rebalance automatically every month. They're diversified across tens of thousands of companies and stocks and bonds. It's extremely simple. So a Lifecycle fund is always one of the first starting points I want to point people to when building an asset allocation. The other thing to consider here is your asset allocation should apply across all of your investments. So if you want to have 100% stock market investment, you need to apply that in your Roth IRA, in your TSP, in your taxable brokerage account. It should apply across all of your investment accounts. And I see people commonly make this error where they're not taking into consideration all of their different investment accounts when they're building their asset allocation. And a simple way to do it is just to have a target date retirement fund in your Roth IRA, a Lifecycle fund in your TSP, and similar target date retirement fund in your taxable brokerage account, and they can all be aligned with the same 2065 or 2070 retirement date. Okay, number two is 100% stocks, global market cap weighted. So if you look at the ETF, the exchange traded fund, Victor Tango, VT, that's a Vanguard Total World Stock Market Index Fund. You can build this in your TSP by using 48% C fund, 12% S fund, and 40% I fund. And interestingly, it's basically the same as the Lifecycle funds 2055 and later up to L2075 now. They're 52% C fund, 13% S fund, and 35% I fund, and less than 1% G and F fund. That would be a totally reasonable portfolio. You're betting on 10,000 global companies. You're betting on capitalism continue to work, and your global market cap weighting. So about 60% of your portfolios in the US and 40% of your portfolios outside of the US. Okay, number three is the Warren Buffett 90-10 portfolio. So this was a offhanded comment he made in one of his Berkshire Hathaway letters where he recommended to his investment advisor, who's going to take care of his wife after Warren passed. He recommended a 90% S&P 500 and a 10% in short-term government bonds. So this would be very easy to implement in your Roth IRA or a taxable brokerage account. You could just buy like VOO. That would be the S&P 500 from Vanguard, Victor Oscar Oscar. You could also implement this in your thrift savings plan with the C fund plus the G fund. So that would be 90% in the C fund and 10% into the G fund, which is a short-term government bonds fund. And then just rebalance as necessary. So that's the Warren Buffett 90-10 portfolio, number 3. Number 4 is pure S&P 500. So this was a very popular portfolio over the last 25 years or so. It's done very well. The United States has crushed all other international markets for a long periods of time. You would have done very well having this portfolio. I mean, Warren Buffett always said, never bet against America. You'd be doing very well having this portfolio for the last 100 years. And you can do this in your TSP by just having 100% C fund. That's it. That's pretty simple. And that's the 500 largest companies in America. Some downsides to this portfolio is no exposure to international markets, international stocks. You have no bonds and you have no small caps, no small capitalization companies in there. So there's 2,000 other companies that trade on the U.S. stock exchanges outside the S&P 500, outside the 500 largest companies in America. There's about 2,500 publicly traded companies in America. So if you're just pure S&P 500, you have no exposure to those 2,000 smaller companies. And a lot of times, those 2,000 smaller companies have great returns, provide great cash flow, and eventually they grow and get added to the S&P 500, which means that you will eventually get access to them, but like, let's take NVIDIA, for example. NVIDIA did not start on the S&P 500. It started as a small capitalization. And if you wanted to own a piece of it, you could have through the S fund, let's say, inside the TSP. Okay, so that's number 4, pure S&P 500. Number 5, the Simple Path to Wealth, J.L. Collins recommends when you're building wealth, you want to invest in the Vanguard Total Stock Market Index Fund. So this is VTSAX, or the ETF version is VTI, Victor Tango India. And then when you retire, you want to transition some of that into bonds. So maybe like 80% stocks, 20% bonds, or 60% stocks, 40% bonds. And that would be like VTI plus the Vanguard Total Bond Index Fund, BND, Bravo, November, Delta. This has no international exposure, but J.L. Collins makes the argument that a lot of the profits that U.S. companies make, especially in the S&P 500, come from international markets. So you don't really need international exposure. Plus, if you look at the last couple decades, the U.S. has absolutely crushed all international markets. But that now means that the U.S. stocks are their price to earnings ratio is very expensive, and European, Asian, other global shares are a lot cheaper. So there could be an argument made that international may outperform the U.S. over periods of time in the future. But J.L. Collins says, don't worry about it. Just buy U.S. So that's number 5, the Simple Path to Wealth, total U.S. stock market. And then when you retire, transition to adding some bonds. Number 6 is a 50-50 two-fund portfolio. So this would be 50% U.S. stocks and 50% bonds. So, or you could do 50% total world stock fund like VT plus a total world bond fund like BNDW. That's the Vanguard Total World Bond Fund. And that's a popular portfolio as well. That's number 6, the 50-50 two-fund portfolio. Number 7, you got the Boglehead 3-fund portfolio. So this was championed by Jack Bogle, the founder of Vanguard, and his followers are known as Bogleheads. And this is you put a third into U.S. stocks, a third into international stocks, and a third into bonds. So in your TSP, this could be maybe a third into the C fund, a third into the I fund, and then a third into the F fund, or maybe 15% each into the F and G fund. That's the F is the fixed interest or the corporate bonds, and G is the government bonds fund. If you're doing this in your Roth IRA, maybe you use Vanguard funds like VTI, that's the Vanguard Total U.S. Stock Market Index Fund, VXUS, Victor X-Ray Uniform Sierra, that's the Vanguard Total International Stock Market Fund, so it's all stocks outside of the United States, and then also a total bond fund like BND or BNDW. Okay, number 8 is the classic 60-40 stock bond portfolio. This is very popular, especially for retirees. Interesting to know if you're using the 4% rule. If you have 40% of your portfolio in bonds, that means you have 10 years of spending, guaranteed spending locked up in bonds. So, and then you but you're still not capping your upside. You have 60% of your portfolio allocated to stocks, which tend to outperform bonds, but tend to be a lot more volatile. So the 60-40 portfolio is very popular. And has been for many decades. And you could assemble this by putting 60% into, say, total global stock fund like VT and 40% into a total global bond fund like BNDW. Or you could keep it US focused and put 60% into VOO or VTI and 40% into BND. And that would be a totally reasonable portfolio that you could probably stick to. Remember, what we're doing here is we're trying to build a asset allocation. We're trying to build a portfolio that you can stick to over decades, that's low cost, automated, diversified, and simple. And you just have to recognize that you're not going to pick the perfect portfolio. You just need to pick a portfolio that you can believe in and stick to over long periods of time. Okay, number 9 is the Rick Ferries. He's actually a Marine veteran. I met him at FinCon once. He's written some great books on asset allocation. He's a CFA, certified financial analyst, and he writes on Bogleheads. He also has a whole website on free portfolios, and he wrote a great book all about asset allocation, all about index funds that you can read. Great guy. And Core 4 is one of his famous portfolios. So that's 48% Vanguard total stock market, 24% Vanguard total international stock market, 8% REIT, and 20% bonds. So it's basically the 3-fund portfolio we talked about earlier, plus a real estate investment trust fund. There are no REITs technically, or REIT funds inside the TSP. So this would be hard to implement inside your TSP, but you could use the C and the S fund plus the I fund and the bonds funds inside your TSP, and then just hold your REIT inside your Roth IRA or in a taxable brokerage account. But it'd probably be better to hold it in a Roth IRA because a REIT has to throw off at least 90% of its profit every year as dividends to its shareholders. So if it's in a taxable brokerage account, that's just not tax efficient. Okay, and then number 10, finally, my personal asset allocation. So currently I'm sitting at 60% US stocks, implemented mostly with VTI and the C and the S fund, 30% international, mostly held in VXUS. That's the Vanguard Total International Stock Market Index Fund through the ETF version, and then 10% bonds split 50-50 between US and international. So you can do that with BNDW or BND plus BNDX, Bravo, November, Delta, X-ray. And that's the Vanguard Total International Bond Index Fund. So again, that's my personal asset allocation. It is probably not appropriate for you, so you don't necessarily need to copy it, but I wanted to mention it. So that's 60% US stocks, 30% international, and 10% bonds. That's what I've stuck to for a couple of years now. When I was in more of an accumulation phase before I achieved financial independence, I was 100% stocks, and I was very comfortable with that because I was earning good money while I was in the military. And so anytime the market was down, I was happy because I was getting stocks cheap. And every time the market was up, I was happy because my net worth went up. So that's my personal asset allocation. I think it's reasonable. I think it's rational. I've managed to stick to it. Since I became financially independent, I've taken the advice of some advisors and taken some money, taken some chips off the table. And by that, I mean I've transitioned from 100% stocks to adding a little bit of bonds. I think as I grow older, I'll probably add some more bonds as well, just for the stability and the fact that I'll know as I'm drawing down my portfolio using the 4% rule that I have many years of savings in bonds. So a good investment portfolio is broadly diversified, low cost, automated, diversified, simple. It's mostly or completely passively managed. We don't use any active managers. You should regularly rebalance. That doesn't necessarily have to mean every year, maybe every 2 or 3 years. And it should be consistent with the portfolio owner's need, ability, and desire to take risk. The Prussian General Karl von Clausewitz, who we have studied extensively in the military, U.S. military, says the enemy of a good plan is the dream of a perfect plan. So don't dream of a perfect plan. Just pick a good plan, stick to it for long periods of time. Make sure it's low cost, automated, diversified, and simple, and you can build wealth while you serve in the military. If you got value out of this podcast, send it to a friend, someone that you know in your squadron, your unit, or your company, and leave us a review. 5 stars on Spotify or Apple is the best way to say thanks.